Right now, silver is trading at $38 per ounce. That's the number you'll see on your phone, on your broker's dashboard, or in the evening financial news. But here's the part the headlines aren't telling you. I believe that within just a few short months, silver could blast past $44 per ounce and maybe much higher. And this prediction isn't some wild gamble. It's rooted in history, hard data, and a market imbalance that's been deliberately ignored. For decades, silver has been treated as the little brother of gold, valuable but less glamorous. And that perception has kept countless investors from recognizing its true potential. The reality? Silver is both a monetary metal and a critical industrial resource. It is in many ways even more essential than gold. One of the most important clues to silver's future is something called the gold-to-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold. Today, that ratio sits at an eye-popping 88. Historically, it's been far lower. Even in modern, manipulated markets, a fair value would be closer to 70. That means silver is undervalued, severely undervalued, compared to gold. And this imbalance won't last forever. The reason? A combination of paper-silver manipulation, industrial demand, and a long history of market corrections. Paper silver refers to ownership of silver on paper through ETFs, futures contracts, or unallocated bank accounts, without owning any actual metal. It's a system that allows institutions to flood the market with artificial supply, suppressing prices and keeping silver cheap. But here's the problem for the manipulators. This kind of price suppression can't last forever. And when it breaks violently. The gold-to-silver ratio, the market's hidden signal, the gold-to-silver ratio, isn't just a quirky statistic. It's one of the most reliable indicators for identifying when silver is undervalued. Right now, gold trades around $3,000 per ounce and silver at $38 per ounce. That's a ratio of roughly 88.1. Let's put that in perspective. In January 1980, silver soared to $50 per ounce, and the ratio fell to just 17.1. In 2011, silver hit nearly $49 per ounce, and the ratio dropped to 31.1. The long-term average over the past century is closer to 50,060. Even in manipulated markets, 70.1 would be far more reasonable today. When the ratio is this high, it rarely stays there for long. Historically, extreme highs in the ratio have been followed by aggressive moves in silver's favor. That's why analysts who track this number see the current reading as a screaming buy signal. Let's run the math. If gold stays at $3,050 and the ratio simply falls from 88 to 70, without gold rising a single dollar, silver would move from $38 to roughly $47.85 per ounce. That's a 26% gain without any help from gold. And if gold climbs at the same time, the gains in silver could be explosive. The paper-silver problem, so why is the ratio so out of balance? The answer lies in the paper-silver market. Unlike gold, silver's market is relatively small. That makes it easier for large financial players to influence its price. On the COMEX futures exchange, there are often hundreds of ounces of paper silver traded for every single ounce of physical silver available for delivery. Some estimates put this leverage at over £300. Here's how it works. Big banks and funds sell massive quantities of silver futures contracts, promises to deliver silver in the future. But they never actually intend to deliver the physical metal. These contracts are rolled over or settled in cash. By flooding the market with this artificial supply, they can push the price down. Why would they want to? Because cheap silver benefits powerful industries. Industrial demand. The silent price driver. Silver isn't just money. It's one of the most important industrial metals in the world. It has the highest electrical conductivity, highest thermal conductivity, and highest reflectivity of any metal. That makes it irreplaceable in solar panels, electric vehicle components, smartphones and computers, medical devices, water purification systems, military technology. As green energy adoption accelerates, demand for silver is rising. Solar panel production alone consumes over 100 million ounces of silver per year, and that number is growing. Electric vehicles use 2-3 times as much silver as traditional gas-powered cars. Industrial buyers have a vested interest in keeping silver cheap. Every extra dollar per ounce adds millions to their costs. That's why these industries quietly support and benefit from paper silver suppression. A history of breakouts. To understand where silver might go next, we need to look at history. In 1980, the Hunt brothers famously tried to corner the silver market. Prices rocketed from around $6 to nearly $50 in just a year. The gold-to-silver ratio collapsed, and anyone holding silver saw life-changing gains. In 2011, amid the aftermath of the 2008 financial crisis, silver soared again, from $9 in late 2008 to nearly $49 in April 2011. The driver? A combination of fear, inflation hedging, and industrial demand. Both times, the trigger was the same. A market that had been artificially suppressed suddenly broke free. Why physical silver is the only real silver. If you buy silver through most brokers, ETFs, or bank accounts, you're buying paper silver. That means you own a claim, not the actual metal. In a real supply crunch, those claims may be settled in cash, not silver. That's why serious investors take delivery of physical silver, coins, bars, and rounds they can hold in their hands. Physical silver can't be printed, deleted, or defaulted on. It's a tangible asset that exists outside the banking system. And in a world where trust in banks is eroding, that matters more than ever. The 2025-2026 outlook, given the current imbalance in the gold-to-silver ratio, the scale of industrial demand, and the unsustainable nature of paper silver suppression, I believe silver has a strong probability of breaking past $44 per ounce within months. From there, a move toward the mid-50s or even 60s in the next 12 to 18 months is entirely possible if the ratio normalizes and gold continues its upward trend. For long-term investors, this isn't just about a quick trade. It's about positioning yourself in a scarce, tangible asset before the rest of the world catches on. Silver at $38 is a rare gift. It's like buying beachfront property before the world realizes the ocean is rising. The gold-to-silver ratio is screaming that silver is undervalued. Paper silver manipulation can't last forever. Industrial demand is accelerating. If you understand these forces and act before the breakout, you won't just be watching silver pass $44, you'll already be there, holding the real thing. Get physical. Get prepared. And don't wait. If this helped you see things differently, drop a comment and I will answer your questions. Subscribe for more honest finance content, and remember, smart money doesn't sit. It moves.